Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, a 4-part YouTube series premiering on April 4th, 2025, designed specifically for DIY investors. Check out these exciting weekly events we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide the information and education you need to gain confidence and empower you to manage your portfolios. You won't want to miss these weekly specials.
Hey everybody, it's Larry Berman here. Hell of a week. A week ago, we talked about our pro-eyes indicators reaching very extreme oversold conditions, but it would take an act of Congress or a tweet by the president to create a market bottom here, and that's indeed, what we saw this week. It's in this week of the Masters, I cracked open an old book here, Trader Vic's Methods of a Wall Street Master. And I met Victor Sparandeo about 30 years ago when I was a lot younger version of myself, probably half the age I am now, actually. We were talking about trading systems and models, and we were talking about different time frames. And I had back then was coding and creating trading systems, and I showed him one, and he goes, wow, this is really great. And he looked at the returns and everything else and the drawdowns, and then I said, yeah, but it was based on monthly charts. And he goes, oh, you can throw that in the garbage, you can't trade off monthly charts. And one of the things he writes about, and that wasn't in this book, it was in the next book after this, Principles of Professional Speculation. And he talked about a system he created on the S&P 500, tested it robustly for years, 20 years, back test. Went paper traded it for a year, then went live with real money, never had more than a 10 or 15% drawdown. And once he went live, he had a 20% drawdown. So, stuff happens that we just can't fathom. And so this was one of those weeks where we had incredible volatility in markets. But the good news is the week ended up well, and as we sit here, I got one eye right here on Masters, and Rory's moving up the leaderboard. And wouldn't that be great if he won the Masters and completed the Grand Slam? Has nothing to do with markets and everything to do with my love of golf. Let's dig into the chart rooms and see if we learned anything this week, because this is just beginning, folks. So in a week defined by market volatility, it makes sense to look at the volatility markets. So what we have here is the VIX that running back a year, and you can see obviously starting April 2nd here, the spike in volatility up to pretty much the highest level since COVID. And it tells you about the environment we're in now and the uncertainty and the fact that we're just starting this trade war with the world. And because of the stress in the debt markets this week, we got a deferral. So what does that all mean to me? It means that this battle is going to not be over anytime soon. It's going to take a lot longer to play out. And therefore more longer term uncertainty, and perhaps now a smoother outcome, a little bit smoother, but still uncertainty for a longer period of time, because it's only been kicked down the road to stabilize the treasury market. This is an indicator that a lot of people use. Some people use the second month VIX futures, of which we saw in the contract tree here. And some people use the front month. So I like to use the front month and the fourth month. And that is, what's the relationship of volatility this month relative to 3 months from now, fourth month of volatility. And when it inverts like this, obviously you got a lot of premium priced into the market for now. So that's what this is. You got the S&P 500 here at the top, and then you have the relationship, the ratio measured in Z-score, so standard deviation from the mean. Now, last August, we had the uncertainty around China, and in particular, in this case, the Japanese currency shock that caused shocking deleverage. It was August 4th or 5th, I believe, were the dates. And so in terms of the spike in volatility, we had front month volatility hitting the 80s. It persisted for all of a couple of days until Japan changed their tune in terms of raising interest rates. So this move in vol relative to that move is actually more benign, but very, very extreme, over history, and it can be basically compared to the Volmageddon shock. Obviously, COVID was something in that move. Generally speaking, the market's a strong buy with two hands when this thing inverts to 2 standard deviations. So we got up to about 3.5 standard deviations. And so part of that, we're in the environment where we should, if a catalyst presents itself, have a ripping rally. And so, of course, the tweet came. The market was at a important technical juncture. We highlighted that on Monday's Berman's Call show, where we had this chart. Now, you run the trend line up under the SPY ETF, which projected just below where we are. You've got the 200-week moving average up there, the 50% retracement. If you look at that, by way of support this week, you see how really relevant that we bounced right off the support level. And so you've got a bullish engulfing week. Normally that's a positive sign, but again, we lack the catalyst other than short covering here to really rip this to the upside. So what could cause that? Xi and Trump shake hands and they've got an agreement. Nothing short of that to me is going to matter too much, because that battle is going to escalate. If what we saw this week with the Treasury auctions, and that the street has bought a lot more foreign indirect buyers, foreign central banks pulling back, what perceives to be more aggressive selling of treasuries in the overnight market typically could come from foreign central banks. All that trading gets done through the New York Fed desk. If they're actually selling holdings on reserve with the New York Fed, they're not, papering the street with bonds. So it's hard to know if the New York Fed in their open market operations is acting for a foreign central bank, if they're just doing stuff for their own balance sheet, etc. But you kind of get the notion. And then you get an update monthly on what the foreign security holdings of the Treasury are. And so you can start to mosaic and put it together, and that's the big worry. We're starting to see stress in the swap markets, massive yield curve steepening, the basis trade unwinding. So the on the run, off the run bonds that are leveraged, I'm hearing $1 trillion of these trades out there. I think that number's too high based on what I see in futures market open interest. But this is what the narrative has been in causing stress to market. I'm wildly bullish on adding duration for a hard economic landing into this stress in the long end. So TLT back to 85, got to 85 even. I had actually today resting orders at 85 and I didn't get done. If I had those resting orders at 85.01, I would have. In the cash market where we buy cash bonds, I had a bid on a low coupon bond for 2050 at 46. It traded at 46. I got no fill. So maybe I stopped the bond market today with my orders. I don't know. I doubt it very much. But sometimes you get lucky and sometimes you don't. Is one of the trading messages, learnings of the week for that matter. So, I love duration here. I think we want to be backing up the truck, but make no mistake, it's not a trade that's going to make you feel good here or feel comfortable. It was only a few days ago that bonds were ripping in a risk off. So, if people are dumping treasuries because they're worried that the U.S. is going to put a tax on foreigners buying treasury bonds, withholding tax, that hasn't been in place since 1978. There was some talk this week that was one of the ways the U.S. was going to raise revenues in this external revenue service that they're manufacturing or whatever. That would be a reason for foreigners to dump treasuries, because on a yield equivalent basis, if they're holding back a tax, they're not nearly as attractive. That would be the dumbest possible policy, I would think, because that would make U.S. debt more expensive. And with the colossal amount of deficits and debt outstanding, they want the U.S. 10-year as low as possible. Getting foreign central banks to buy more of that, or changing the regulation so the U.S. domestic banks can buy more of it, is what we need to see. So I doubt that policy gets put in place. Anyways, there's a lot going on here. Equity market rallies, I think, are limited. Going back to our chart here, call it 5,500, 550 on the SPY. It was support a few weeks ago prior to the April 2nd shock. And it would be absolutely surprising to me if the market were able to recover now above that. And while Goldman Sachs rolled back their recession risk because this got, the acuteness of tariffs, broadly speaking, got kicked down the road, calmer heads are prevailing. So that's great. But I don't think that changes the notion of a harder economic landing. It does help mitigate the downside risk to equities. Gina Martin Adams put together a forecast this week based on typical recessions. Earnings per share, if we look at earnings per share, tends to decline about 11% in a garden variety recession. So we've got 245 in the bank. If we go down to 220 in a garden variety recession, assuming the multiple stays the same right now, forward multiple of 19, that 20, that gives you 42 to 4,400 on the S&P 500. And so another leg down is highly probable at some point, but we need to start to see the economic decay in the employment markets, in the real economy, and consumer spending. Consumer confidence is in the tank. It's in the tank largely because of inflation concerns, probably some job concerns with what Doge has been doing. And so it's going to be very hard for this market to recover. Bottom line. We're playing a lot of defense in portfolios. I'm a buyer of dips and weakness, 4,800, 4,600, I don't care. Down there, you got to plug your nose and buy it for the next few years. But for now, use market rallies to just lighten up where you can if you're the trading type out there. Anyways, that's the world as I see it this week. For those celebrating Passover like myself, have a great week. Enjoy the Seders with families, as I will be this weekend. And of course, watch the Masters and root for your favorite guy, but I'd love to see Rory win this thing finally. Have a great one, everyone.